Three, two, one. Welcome to the John A.G. Live.
It's official. Mainstream media just admitted it. CNBC, the network that spent years ignoring silver, dismissing silver, calling silver a Reddit meme, just published a headline confirming that today's price action was the biggest intraday move since the 2008 financial crisis. Let that sink in. Bigger than COVID. Bigger than the 2020 shutdown, bigger than every market panic, every inflation scare, every supply chain crisis of the last 15 years. The only comparable event was the complete collapse of the global financial system in 2008. And they're panicking. You can hear it in their voices. You can see it in the headlines. They crashed silver $14 in minutes, from 117 to 103, and they couldn't keep it down. It V-shaped back up. The recovery was immediate, the whales stepped in, the physical buyers absorbed everything the paper market could dump. This wasn't a correction, this was desperation. This was the banks throwing everything they had at silver to break the momentum, to shake out retail, to create the illusion of a top. And it failed. The chart doesn't lie, the volume doesn't lie, the V-shape doesn't lie. They tried to kill the rally, and the market told them no. Now listen carefully. If you're glad that silver recovered, if you're glad that the banks failed to break this move, I need you to do something right now. Hit the like button. Smash it. Crush it. Because YouTube's algorithm is watching, and every single like on this video forces the algorithm to show this truth to more people. To every person who panic sold at $103, to every person who listened to the bearish analysts, to every person who still thinks this market is being driven by fundamentals instead of manipulation. The banks want this video buried. They want you confused. They want you scared. But your like, your engagement, your voice tells the algorithm that this message matters, that people want the truth, that the resistance is real. So hit the like button right now. Don't wait. Don't scroll past this. Do it now and let's expose the manipulation together. And if you hit that like button, I want you to prove it. Go to the comments right now and type, "I did my part." So me and my team know who is actually helping us fight this algorithm. Don't just watch, participate. Type, "I did my part" below. Good. Now let's talk about what actually happened today. Because there's a war going on, not just in the silver market, but in the narrative, in the story that analysts and institutions and mainstream media are telling you about what this move means. On one side, you have Jakub Bartoszek, the CEO of Cashify Gold. He came out today and said something that no mainstream analyst wants to admit. Silver breaking $100 is not a correction, but a global short squeeze on physical metal. A short squeeze on physical metal. Not a speculative bubble, not a Reddit-driven pump, not a momentum trade that's going to crash back to $30, a structural supply crisis where the physical market is squeezing the paper market and forcing prices higher because there isn't enough metal to meet demand. Bartoszek pointed to the evidence. Significant drainage of LBMA vaults in London, COMEX inventories collapsing, the gold-to-silver ratio, the number of gold ounces it takes to buy 1 ounce of silver, collapsed to 46 to 1. That's the lowest level in 15 years. 6 months ago, that ratio was 120 to 1. What does that mean? It means silver is outperforming gold by a factor of 3. It means the market is repricing silver relative to gold because the supply situation is that dire. It means industrial demand is so overwhelming that silver is no longer just poor man's gold. It's the most critical industrial metal on the planet. That's Bartoszek's thesis. That's the bull case. That's what the data actually shows. But on the other side, on the villain side, the side that wants you to sell, the side that profits when retail gets shaken out, you have Heraeus Precious Metals. Heraeus is one of the largest precious metals refiners in the world. They handle physical metal. They know the inventories. They know the demand. They know the supply situation better than almost anyone. And today, on the same day that silver experienced its biggest intraday move since 2008, they released a statement saying, "History suggests this rally is much nearer to its end than its beginning. The rally is over. Sell now. Take your profits. Get out while you can." Does that sound like a refiner who's worried about running out of inventory? Does that sound like someone who's seeing unprecedented physical demand and can't keep metal on the shelves? Or does that sound like someone who wants you to sell so they can buy your metal at lower prices? Let me be very clear about what Heraeus is doing. They are talking their book. They are protecting their position. They are part of the system that benefits when retail investors panic and dump their positions into the hands of industrial buyers who need the metal. Because here's what they're not telling you. Here's what CNBC buried at the bottom of their article. Physical demand now accounts for roughly 50% of annual silver production, half of global supply. That's not speculative demand. That's not investment demand. That's industrial consumption. Solar panels, electric vehicles, data centers, AI infrastructure, 5G networks, medical devices, missile guidance systems. These industries need silver. They consume it. They can't substitute it. They can't wait for prices to come down. They have to buy it at any price because their entire business model depends on securing supply. And Heraeus, a refiner that sits at the choke point between mines and manufacturers, wants you to believe the rally is over. They want you to sell your position right when physical demand is hitting all-time highs. No, they want your metal. They want you scared. They want you out. But here's the beautiful part. Here's the part that proves we're winning. Gary Christie from Trading Central, a technical analysis firm with no dog in this fight, came out and said the exact opposite. He said the market remains in established uptrends despite the volatility. Translation, the bull market is intact. The crash was noise. The trend hasn't broken. And anyone telling you to sell right now is either lying or doesn't understand what's happening, so you have to choose. Do you listen to Heraeus, a refiner with a vested interest in keeping prices low? Or do you listen to Bartoszek, who's calling this a short squeeze? Do you listen to the bearish narrative designed to shake you out? Or do you listen to the chart, the volume, the V-shape, the physical premiums, and the empty vaults? Pause for a second. I want your vote on this. Who do you trust more, the refiner, Heraeus, or the math? Type Team Refiner or Team Math in the comments. Let's see if anyone actually believes the banks anymore. I know which side I'm on, and if you're watching this channel, you know which side you should be on too. Now let's connect the dots. Let's talk about who's actually driving this demand. Because CNBC mentioned it, they buried it in the article, they didn't emphasize it, they didn't make it the headline, but they admitted it. Electric vehicles, solar panels, data centers. These are the sectors driving silver demand to record levels. Electric vehicles. Who makes electric vehicles? Who just announced a revolutionary solid-state battery that requires 1 kilogram of silver per car? Who prepaid $7 million to buy an entire Mexican silver mine to secure their supply chain? Samsung. While you were watching the price crash from $117 to $103 this morning, while you were refreshing your portfolio and panicking and wondering if you should sell, Samsung was on the phone with physical dealers buying metal at $120, $125, $130 per ounce. Because Samsung doesn't care about the COMEX price. Samsung doesn't trade futures. Samsung doesn't speculate. Samsung needs physical metal to build batteries, 1 kilogram per vehicle, not 20 grams like the old lithium-ion technology, 1 full kilogram. And their entire EV strategy, their entire transition into the electric vehicle market depends on securing that silver. So when the paper price crashes $14 in 15 minutes, do you think Samsung is getting scared? Do you think they're waiting for lower prices? No. They're buying the dip. They're thanking whoever crashed it for giving them a discount. This is the same company that bypassed the futures market entirely and bought a mine. They didn't trust COMEX to deliver. They didn't trust the paper market to reflect physical reality. They went directly to the source and locked in their supply. And they're not alone. The U.S. Pentagon, the Department of Defense, launched a $2.5 billion emergency stockpiling program in 2025, not for investment, not for speculation, for national security, because modern warfare runs on silver, and they have zero strategic reserves. Missile guidance systems, radar, munitions, naval destroyers, fighter jets, all of it requires high-purity silver, and the Pentagon is competing with Samsung and Chinese manufacturers for the same metal. Defense contractors warned last year, we face a choice between arming ourselves, arming allies, or conserving silver-intensive components. They're rationing silver. The U.S. military is rationing a metal because they can't secure enough supply. And you think Heraeus is right? You think the rally is over? You think demand is going to collapse? No, the demand is structural, it's industrial, it's non-negotiable. And every time the paper price crashes, it's creating a buying opportunity for the entities that understand the supply crisis better than anyone else. CNBC said it themselves. They called out EV demand as one of the primary drivers. That's code for Samsung, That's code for Tesla. That's code for every electric vehicle manufacturer on the planet that's transitioning from lithium-ion to solid-state batteries and suddenly needs 50 times more silver per vehicle. And while the mainstream media is debating whether the rally is over, Samsung is locking in supply. They're buying mines. They're signing long-term contracts with refiners. They're securing their position for the next decade. And you sold at 103? You listened to Heraeus? You trusted the paper price instead of the physical market? Then you just handed your metal to the most powerful industrial giant in the electronics industry at a 15% discount? But maybe you didn't sell. Maybe you held. Maybe you saw that crash and you didn't blink. Maybe you understood that paper manipulation doesn't change physical fundamentals. And I need to know who's still standing, who's still in this fight, who understands what we're witnessing. So stop what you're doing right now. Stop scrolling. Stop multitasking. Go to the comments and tell me two things. First, where are you watching from? What city? What country? What time zone? I want to see that this community spans the globe. I want YouTube's algorithm to see that people from every continent are paying attention to this message. Second, did you hold or did you sell? Be honest, no judgment, but I need to know. If you held through the crash, if you saw $103 and added to your position, comment diamond hands. If you bought the dip, comment bought the dip. And if you sold, if you panic sold, if you got shaken out, comment lesson learned. Because this will happen again. They will crash it again. Every time silver builds momentum, every time retail starts to believe, every time we approach a new high, they will execute another stop-loss hunt during low liquidity hours and try to break the move. And if you sold at $103, you need to learn from this. You need to understand the game they're playing. You need to be ready for the next attack. So comment right now. Tell me where you are. Tell me what you did. Let the banks see that the resistance is real, that we're not going anywhere, that every crash just creates more buyers who understand the thesis. I'm reading every single comment. And the banks are watching too. Let's show them what they're up against. Good. Now let's zoom out. Let's talk about the bigger picture. Because silver isn't moving in isolation. This isn't just a silver story. This is a monetary story, a currency crisis, a collapse of confidence in the system itself. Gold just broke $5,000 per ounce for the first time in history. The intraday high was $5,111.07. That's not a typo. $5,111. 6 months ago, gold was at $2,400. It's more than doubled. In 6 months. That's not normal market behavior. That's not a bull market. That's a parabolic move driven by fear, by inflation, by geopolitical chaos, by the complete loss of faith in fiat currencies. And why is gold moving? CNBC called it the inverse of confidence. It's a hedge against Federal Reserve policy. It's a hedge against Trump's geopolitical threats, Greenland, Venezuela, the Panama Canal. It's a hedge against a system that's printing trillions of dollars and debasing the currency in real time. When gold breaks $5,000, it's not because people are bullish on gold, it's because they're bearish on everything else. It's because they don't trust the dollar. They don't trust central banks. They don't trust the system to protect their wealth. And silver? Silver is gold's little brother. Silver moves when gold moves, but silver moves faster. Silver moves harder because silver has the monetary premium of gold plus the industrial demand that gold doesn't have. Gold is a store of value. Silver is a store of value and a critical industrial commodity. That's why the gold to silver ratio collapsed from 120 to 1 to 46 to 1. That's why silver is outperforming. That's why the short squeeze is happening. Because the world needs silver. Not just wants it, needs it, and there isn't enough to go around. The United States just designated silver as a critical mineral by the Department of the Interior. That's the same classification as lithium, cobalt, rare earth elements, metals that are essential to national security and economic competitiveness. They don't give that designation to speculative assets. They give it to metals that are strategic, that are irreplaceable, that are in short supply. And that designation happened before silver broke $100. Imagine what happens now that we're above $100. Now that the supply crisis is becoming mainstream news, now that Samsung is buying mines and the Pentagon is launching emergency stockpile programs, the narrative is shifting, the mainstream is catching up, and Heraeus, the refiner that wants you to sell, is going to be proven catastrophically wrong. Because here's the reality they don't want you to see. COMEX registered silver inventories have been drained 70% since 2020, from 346 million ounces to 82 million ounces. London LBMA vaults are down 40%. Shanghai inventories are at decade lows. In December 2025, 60% of COMEX registered silver was claimed for physical delivery in the first 4 trading days of the month. 4 days, not 4 weeks, not 4 months, 4 days. That's not normal profit taking. That's not speculative demand. That's a run on the vaults. That's industrial buyers and sovereign wealth funds and institutional investors realizing that the paper market is a fraud and the only thing that matters is physical possession. And the number of paper contracts outstanding, it represents roughly 300 times more silver than physically exists in COMEX vaults. 300 to 1. That's not a market. That's a Ponzi scheme. That's a house of cards waiting to collapse the moment too many people ask for delivery, which is exactly what's happening. Samsung asked for delivery, so they bought a mine. The Pentagon asked for delivery, so they launched a $2.5 billion stockpile program. Chinese manufacturers asked for delivery, so they're draining Shanghai inventories to decade lows. Everyone who needs the metal is bypassing the paper market, and Heraeus wants you to believe the rally is over. No, the rally is just beginning. Because once the vaults are empty, once the paper market can't deliver, once the disconnect between COMEX prices and physical prices becomes undeniable, the entire system breaks. And we're already seeing it. This morning, while COMEX crashed to $103, physical dealers in Shanghai were quoting $120 to $130. In Japan, $120 to $130. In Dubai, $125 to $130. The widest gap ever recorded between paper and physical. That gap is the proof. That gap is the smoking gun. That gap is the market screaming that the paper price is a lie and the physical price is the truth. And every time they crash the paper price, they're giving you, the informed investor who understands this dynamic, a gift, a discount, a chance to accumulate real metal at fake prices. So don't listen to Heraeus. Don't listen to the bearish analysts. Don't listen to the mainstream media that spent years ignoring silver and is now scrambling to explain why it's moving. Listen to the empty vaults. Listen to Samsung buying mines. Listen to the Pentagon printing $2.5 billion. Listen to the gold to silver ratio collapsing. Listen to physical premiums staying elevated while paper prices crash. Listen to the fundamentals. And the fundamentals are screaming that we're in the early innings of a supply crisis that will rewrite the economics of every industry that depends on silver. Solar panels now consume 29% of all industrial silver demand. That's up from 11% in 2014. Electric vehicle demand is up 51% since 2016. AI infrastructure, data centers, 5G networks, cloud computing is creating new demand that didn't exist 5 years ago. And global mine supply, it peaked in 2016. We're not finding new deposits fast enough. We're not building new mines fast enough. We're not refining enough metal to meet current demand, let alone the demand that's coming from the EV transition and the AI boom. Silver has been in structural deficit for 5 to 8 consecutive years. That means the world consumes more silver every year than mines produce. The deficit in 2025 was estimated at 120 to 238 million ounces. In 2026, it's going to be worse. Because Samsung's solid-state batteries are entering mass production. Because the Pentagon's stockpile program is launching, because solar installations are accelerating, because EV adoption is accelerating, because every trend that drives silver demand is pointing up, while every trend that drives silver supply is pointing down. This is not a speculative bubble. This is not a meme stock rally. This is not retail FOMO. This is a structural supply-demand imbalance that cannot be fixed by printing money or changing margin requirements or crashing the paper price during Asian trading hours. The only way to fix the supply deficit is to ration demand or increase supply, and you can't ration industrial demand. Samsung can't build batteries without silver. The Pentagon can't build missiles without silver. Solar panel manufacturers can't meet climate goals without silver. So the market has to ration demand through price. Prices have to go high enough that marginal demand gets priced out, high enough that some industrial users find substitutes or delay projects or reduce consumption. But we're not there yet. At 103, at 112, at even 117. These prices are not high enough to destroy industrial demand. These prices are still cheaper than the cost of finding alternatives. These prices are still cheap enough that Samsung is willing to pay them to secure supply, which means prices have to go higher, much higher, until the market clears, until supply and demand actually balance. And Heraeus thinks the rally is over at 103s. They think this is the top. Then they're either lying to you or they're incompetent. And given that they're one of the largest refiners in the world, I'm going with lying. They want your metal. They want retail to panic. They want you to sell into the crash so that industrial buyers can scoop up your position at a discount. Don't give it to them. Hold your silver. Buy the dips. Ignore the manipulation. Ignore the bearish narratives. Ignore the analysts who have been wrong about silver for 15 years straight. Because this move, this rally, this short squeeze, this supply crisis is bigger than 2008. CNBC admitted it. The data confirms it. The vaults prove it. And the banks are panicking. You can see it in the desperation of the crash. You can see it in the speed of the recovery. You can see it in the margin hikes and the low liquidity attacks and the bearish narratives from refiners who need metal. They're losing control, and they know it. So subscribe to John AG Live, hit the notification bell, share this video with everyone who needs to understand what's happening, comment your location and your position, join the resistance. Because this is not just about making money. This is about exposing a system that's been manipulating precious metals for decades. This is about holding the line when they try to shake you out. This is about being on the right side of the biggest supply crisis in modern history. Gold just broke $5,000. Silver just survived its biggest intraday move since 2008. The vaults are empty. Industrial demand is 50% of production. Samsung is buying mines. The Pentagon is printing billions. The rally is not over. The rally is just beginning, and everyone who sold at 103 is going to watch from the sidelines as silver rewrites the record books. One final question before you go, and be honest. Do you think silver breaks $150 by next week? Yes or no? Let me know your prediction below. If you haven't subscribed yet, click that button now so you don't miss the next crash alert, and if you forgot to like the video earlier, hit it now. Don't be retail. Be the whale. Hold the line.